Hello there, and a very warm welcome to our webinar today, all about Directors National Insurance in Sage 50 Payroll. My name's Duncan, I'm your host and presenter, and I am joined today by my colleagues Alice, Matt, Ollie and Paddy, who are all standing by in the background, ready and waiting to answer any questions. Let's now take a look at what we'll cover in the webinar. So I'll start with an introduction, explaining how national insurance is calculated and the difference between non-director and director calculations. We're then going to talk about director statuses, which will determine how national insurance is calculated for the director, either on the annual basis or what we call the pro rata basis. I'm then going to give you some demos and go through some example calculations of directors' national insurance, and we'll be looking at a few different scenarios to highlight some common scenarios that pop up. And we will finish the webinar today with a quick look at anything that's new in 25 to 26 in relation to directors' national insurance, including the secondary threshold changes and the change to the employer NI rate. So let's get things started by explaining how national insurance is calculated. But before we do that, I thought we'd start with the definition of a company director for national insurance purposes. So special rules apply to company directors when it comes to calculating national insurance. And the definition can be found in the HMRC guide CA44, which I have linked to on this slide. So as you can see, for NI purposes, the regulations define company directors as a member of a board or similar body where the company is managed by a board or similar body, or a single person where the company is managed by an individual. So it's that definition that determines whether the director national insurance rules apply. If you're in any doubt, I would recommend that you contact HMRC's employer helpline, and they can help to clarify whether or not your employee should be processed as a director. So it's not necessarily just having director in the job title, it does need to fit that definition. So how are national insurance contributions calculated for both non-directors and directors? Well, the difference is whether it's a cumulative calculation or not. So in the case of non-directors, national insurance is calculated each period using the earnings in that period only, and then either weekly or monthly thresholds, depending on the employee's pay frequency. So each period is taken in isolation. It's a non-cumulative calculation for non-directors. The difference with directors is that by the end of each tax year, national insurance for directors must have been calculated using their earnings to date, the cumulative earnings, and the yearly thresholds. And the reason why I say by the end of the tax year is you can calculate it on this basis for the full tax year, or you can calculate it as a non-director and recalculate in the final period of the year. So the NI thresholds for the current tax year, 2024 to 25, are shown on the slide here. So you have a lower earnings limit, which is currently £123 per week. There's a secondary threshold. So this is the point at which employers start to pay national insurance. You've got your primary threshold, which is the point at which employees start to make their contributions. And then you've got your upper earnings limit, which in the case of an employee, it's when the rate will reduce for standard rate contributions down to a slightly lower percentage. Now we've got the current percentages for the contributions on the slide as well. So on earnings above the secondary threshold, the employer national insurance is calculated at 13.8%. Earnings above the primary threshold and up to the upper earnings limit, the employee pays 8% on category A, and then above that upper earnings limit, the employee's percentage goes down to 2%. So it's these thresholds and rates that determines how much national insurance is paid. It's calculated per period for non-directors, but for directors, it needs to use cumulative earnings and yearly thresholds by the end of the year. Now, I will quickly show you some of the changes to the legislation coming in the new year, but we will cover this at the end of the webinar. So the secondary threshold, the point at which employers will pay national insurance, is reducing in 2025 to 26. So yearly, it's going down from £9,100 to £5,000. And the employer's NI rate is increasing on earnings above that secondary threshold. So that's going up to a 15% rate for NI category A. So just some changes to be aware of. All of this legislation is built into your program. So as soon as you start processing in the new tax year, the new legislation will come into effect. So what I want to talk about next is the director status, because this will determine at what point the director pays their national insurance and whether or not there will be a recalculation at the end of the year. So there are two statuses to choose from in Sage 50 Payroll. There is the director annual basis, where national insurance is calculated using a cumulative calculation, so on the annual method throughout the tax year. And this would often mean at the start of the tax year, when the cumulative earnings may be below the annual primary threshold, the director doesn't actually pay any national insurance to start with, but then they will start to pay their national insurance on all of their earnings above that primary threshold, and the rate would reduce if their earnings to date happen to go above the upper earnings limit. So as that's a cumulative calculation, there's no recalculation at the end of the year. But the other way that you can choose to calculate it, the pro rata basis, as we call it in Sage, is when national insurance is calculated in the same way as a non-director, so using either weekly or monthly thresholds and based on the earnings in that period, but then recalculated in the last period of the tax year or the last period of directorship if that director is leaving the company. So I'm going to show you where you can choose the director status, and really it is your choice which way you're going to process your directors. But what I would say is that the pro rata basis is more suited to a situation where the pay doesn't vary throughout the year, as it allows your employee to effectively spread the cost of their national insurance more evenly throughout the year. And as you'll see as we go into some of the demos later on, if there have been variances in the pay, it can throw up some maybe unexpected results when you get your recalculation at the end of the year. So we're going to take a look at the director status in the program. So let me just bring these slides down. Now, all of the employees that I've set up for this demo are set up as will be set up as directors. One of them is becoming a director during the year. And if we just take a look in the employee record, you can go onto the employment tab and you would find the director status here on the right-hand side. So opening this drop-down list, you can see the three different options. You've got non-director, director annual basis, and director pro rata basis. Now, if you have selected one of the director statuses, within the year-to-date values, which I'm going to show you down here, you will find an extra tab for directors NIC. And when I click on this tab, this is where you record the date the directorship began, which in this case was in a previous tax year. And it keeps a record of the NI categories that have been used throughout the year and kind of the cumulative earnings used in the director's calculations. So you will only ever see this tab where you've set up the director status. Now, it's worth mentioning that once you've set a director status, there are restrictions on when you can change this. Now, if an employee becomes a director at any point during the year, you can switch to either of the director statuses from non-director, and you would need to ensure that you have recorded the date directorship began so that the calculations work out correctly from that date. But once they are on a director status, if you've chosen annual basis, you won't be able to switch to pro rata basis. As you'll see, a message pops up telling you that NI legislation does not allow this change. Now, if you do want to use the pro rata basis, you can switch it at the start of the next tax year, but you can't do this change mid-tax year. If you were on pro rata basis, you can switch to annual basis at any time. But if you're a director and you cease to be a director during the tax year, under the NI rules, you must complete that tax year with director's calculations, and then you can change to non-director in the new year. So if I try and change from director to non-director, again, we get the message that you can't cease to hold director status for NI purposes during a tax year. The earliest I could make that change, again, would be the start of the new tax year. So that is where you find the director status. I've got different statuses set up for different employees for the demos today. And we're going to work through some of the calculations as well in a few moments' time. So that's a little bit on the director status and just confirmation of when you can make changes. So pro rata basis to annual basis could be done at any time. So you can switch to the annual calculation mid-tax year if you needed to. But annual to pro rata basis can only be done at the start of a new tax year. Director to non-director, again, start of the new tax year, but non-director to director, again, any time when they have been appointed director. So we're going to see how the director status affects the calculation. The way that this is going to work is I'm going to run through some scenarios first in Payroll to show you the calculation being done in the program, and then we'll kind of break down the calculation looking at some of the reports for the year. So let's just rejoin the demo. For this demo, I'm processing month 12, so it's the final period of the year for me. And this is when any pro rata directors will have their national insurance recalculated. So I'm going to start by selecting the first 2 employees in my list, both directors. They've both been paid exactly the same amount each period in terms of their gross pay. But the thing that differs here is their director status. So if I take a look in the employee record, you can see the first one is annual basis. And the second one here is set up as pro rata basis. But looking at the history, they're getting £5,000 basic salary per month. The net pay has been calculated for each of them, and we've got exactly the same for the other director, but you might have noticed straight away that the net pay figures are a bit different. But come the end of the year, they will be the same. So let's enter the payments for month 12, which is the final period of the year. So for both of these directors, in this period, national insurance will be calculated using a cumulative calculation. So for the first employee on annual basis, they're getting their £5,000 salary. And at this point, their earnings to date are above the yearly upper earnings limit. So the employee's national insurance, or the director's national insurance they pay themselves, is £100. And £100 is 2% of their £5,000 salary, because they're at the point where their contributions have reduced to the 2% amount. To check the employers, we can click the employers button at the bottom, and national insurance for the employer is £690. 690 is 13.8% of the £5,000, as that's the rate that is paid on all earnings above the annual secondary threshold. So no recalculation for this employee, but they will have found towards the end of the year the amount of national insurance they paid reduced because they've got to the point where the earnings were above the upper earnings limit. Now looking at the other employee who earns exactly the same salary each period, their national insurance is a bit higher. It's £268.10. And when we save that payment, it does tell us that they've been recalculated on a year-to-date basis. Looking at the employer contribution, £584.80. But then if you check the information, which gives you a bit more information on how things have been calculated, if I look at the national insurance section, just check the NI to date. So for this employee, 321060, and going back to the previous director, exactly the same, 321060. So over the year, they've paid the same national insurance. It's just when they've paid it has been determined by the director status. Now, if I just update the records for this final period. so that has now been completed. I'm just going to show you a report that will compare both of these employees. So I'm going to run the employee history report, detailed version, which you would find in the employee folder within the main reports. So this gives a good summary of gross pay, national insurance and tax. And if I run it for the full tax year, what we can see if we just zoom in is that the totals for each of these employees end up being exactly the same. So employers NI, employees NI, tax and net pay over the year is the same. But if you look at it month by month, it's different because of the way their national insurance has been calculated. So they've been able to spread it out a bit more evenly on the pro rata method as compared to the annual basis. So started off there with quite a simple example, but I want to work through that calculation with you just on screen. So I've got that same report shown on screen there. The NI annual thresholds are used for the annual calculation. So we've got your secondary threshold and primary threshold there for tax year 24 to 25. Earnings for NI to date was £60,000 in this example. So that was the same for both of these employees. And when it comes to calculating the national insurance, for the employer, we simply subtract the secondary threshold from the earnings to date. So 60,000 minus 9,100. And then we multiply that by the employer's percentage of 13.8%. And that gives us the amount of employer NI, which is £7,024.20. And you can see that's exactly what we saw on the report come the end of the year for both of these directors. For the employee, there's a couple of extra steps involved. So the employee's earnings to date was above the upper earnings limit. So first of all, we'll take the earnings to date minus the upper earnings limit and multiply that by 2%. So that's the national insurance payable on earnings above the upper earnings limit. And then we take the earnings between the primary threshold and the upper earnings limit. And the employee's percentage for those earnings is 8%. That's £3,016. If you add those two amounts together, we get our employees' national insurance, which was 3,210 and 60 pence. So you can see, come the end of the year, they have both paid exactly the same. Now, for the next example, we're going to look at a recalculation for an employee on a pro rata basis, but this is an employee where the pay has varied a little bit throughout the year. So we're going to see what impact that might have on the national insurance they pay. So I'll just bring these slides down again. And for this next example, I've got two directors. Again, their earnings are exactly the same, their gross pay. It's just a director status that is slightly different. And looking at the history of their payments this year, they're getting a basic salary of £1,500 per month. But there was 1 month during the year where they had a bit of a spike in their pay. They also received £10,000 bonus. And we'll see the impact of that in the recalculation. But you can see for both employees, or both directors in this case, gross pay is exactly the same over all of those periods. So we're going to go into the enter payment screen for both of these employees. So this month they're just getting their usual salary. So this is a director on the annual basis. And you can see this was their earnings. The national insurance that they've paid, £120 is actually 8% of their earnings, because their cumulative earnings are above the primary threshold, but below the upper earnings limit. And for the employer, this £207 is 13.8% of their basic pay. Looking at the next employee though, their national insurance this month seems quite a bit higher than it usually is for that basic salary. So it's £475.30. And when I save these payments, we get the message that they've been recalculated on a year-to-date basis. The employer contribution looks a bit more normal, but there isn't any change in the rate for employer NI. And then looking at the information, we're looking at the employee NI to date, 123,440. We can see, again, if we move back to the previous employer, it has worked out exactly the same. Now, let's work through the calculation for that one. So specifically, the employee on the pro rata basis. So their earnings up until month 11, cumulative earnings were £26,500. We have their NI contributions to date, which previously had been calculated using monthly thresholds in this example. And then we know their earnings for the last period of the year, £1,500, meaning their earnings to date, come the end of the year, were 28,000. So this is the period where the annual calculation is done. So for the employer, that involves taking the secondary threshold away from their earnings to date. So 28,000 minus 9,100, and then multiplying by the employer percentage, 13.8%, which gives us 260820. But then we subtract the national insurance they've already paid throughout the year, which was based on monthly tables. And that leaves the employer paying £101.80. So not too different to what they pay on that salary in other months. It is the employee that sees the big difference though. So to work out the employee national insurance, we take the earnings, and in this case subtract the primary threshold, 12,570. We multiply that by the 8%, which is what they owe on earnings above the primary threshold, up to the upper earnings limit. So that's our 123,440 that we saw in the program just now. But then if we take away what had been paid throughout the year, you can see that that has jumped up to £475.30 being owed. And the real reason for that is in December, when they received their bonus, their pay was way above the monthly upper earnings limit. So they'd have paid a lot of national insurance at 2% at the time. But now that it's been recalculated at the end of the year, actually turns out that they owed more national insurance on that payment, and they are paying that in the last period of the year. So that's when it can throw up maybe unexpected results. If the pay is going to vary, the director might prefer to be on the annual method, thus avoiding any surprises like this. So a couple of other scenarios I want to show you. So we're going to have a look at a change of status. So let's just return to the demo again. So I have here a director who became a director midway through the tax year. So it was actually on the 1st of January 2025 that they switched from being a non-director to a director. So I'm going to set my date back to the 31st of March, which was the first time they were paid as a director. And what we would need to do to make this change is to go into their record, change the director status. So we are going to opt for annual basis in this example. When you change a director status, it advises you to check the date directorship began, because it will default to the current process date. But actually in this case, it was the 1st of January. And once you've changed the status, you go into the year-to-date values. And this is where you find the director's NIC tab. Now they do have earnings as an employee, which are now kept separate to their earnings as a director. But it's this date just here that we need to enter correctly, as when they are appointed director midway through a tax year, the annual thresholds are adjusted to take into account just the weeks that they've held director status. So really important that that date directorship began is correct. And once you've made that change, you can then start processing them as a director. So this is the employee's earnings each month, £2,500. And actually in this first month as a director, they're not paying any national insurance. So their earnings to date as a director are below that primary threshold. The employer is paying some national insurance, So at this point, they have reached the secondary threshold, the adjusted secondary threshold for someone that became a director on the 1st of January. So moving forward for this employee, if I just update their records in the next period, we would enter their payments. So they're now starting to pay national insurance because earnings to date are above the primary threshold. So this figure here, 12920, represents an 8% contribution on earnings above the primary threshold. And for the employer, you can see that's being calculated, and that will continue to the end of the tax year, and moving into the new year, the calculation will be based on the full annual thresholds. So just to go through the numbers on that one. So when an employee becomes a director during the tax year, you must record the correct date the directorship began. And based on that date, the program works out how many weeks are in the period, the pro rata period that they've been a director in the year. So in this example, it was 14 weeks. So the annual thresholds are adjusted to take into account they've only been a director for 14 weeks. So new thresholds are in play in this particular example. Come the end of the year for this director, because they earn £2,500 per month, they'd have earned £7,500 as a director. So the way that this calculation has gone is that we take that £7,500, subtract the primary threshold, the secondary threshold for the employer, which is 2,450, been multiplied by the employer percentage to give the employer's NI due. And then it's done a similar thing for the employee. So again, just looking at the earnings as a director, and for the rest of this year, the pro rata annual thresholds. So 7,500 minus 3,385, and then it was an 8% contribution on those earnings. So just got one more of these, you'll be pleased to hear. So we're going to take a look at a director who's leaving. So this employee has been set up a director on the pro rata basis. So it means the national insurance is being calculated using the monthly or weekly thresholds each period. If they were still a director at the end of the year, or if they're still with us at the end of the year, that's when their NI would have been recalculated. But actually, we're going back in time here a little bit, because this employee is being paid for the last time in June of 2024. And because it's their final payment, because they're leaving the company, when we go into the enter payment screen, at the moment, the national insurance is being calculated using the monthly threshold, but we do need to tick this box at the bottom of the screen to say that they are leaving and this is their final payment. So you then get the usual message advising you to update records before running the Leaver Wizard. But it then tells us that this employee is a director on the pro rata basis. We should only select this box if they're leaving and this is their final payment, which happens to be the case. And then it does mention that if they're still working for you, but you want to switch them to annual basis, you can change the status to annual basis rather than tick that box. But that's not what we're doing. They are actually leaving. And as you can see, that has resulted in a negative value for the employee's national insurance, and also a negative value for the employer. And that's because it's quite early on in the tax year. It's only month 3. So it's been recalculated using annual thresholds and cumulative earnings, and it does mean they're going to get some of this national insurance back. So it's important you do that in the final payment for a pro rata director if they're leaving. Happens automatically in the final period of the year, as you won't be able to make them a leaver, you won't be able to run the Leaver Wizard unless their national insurance has been recalculated. So you would then update the records, and then you could run the Leaver Wizard as normal. So this was the example that we've just been through. They were leaving in month 3. They had been paid using monthly tables up until month 2. So another £4,000 was paid in month 3, meaning their earnings to date were £12,000. For the employer, we subtract the secondary threshold from those cumulative earnings and multiply by 13.8%. So that gives us £400.20 of employer national insurance due. But they had already paid £894.80, the employer national insurance. So in that final period, that has resulted in the refund. So the employer will get that money back when they make their payment to HMRC, because it will be reduced by the amount of this refund. For the employee, their earnings to date was £12,000, but the annual primary threshold is £12,570. So on that basis, they don't owe any national insurance. Under the directors' rules, based on their cumulative earnings and annual thresholds, even though they left in month 3, there's no national insurance due. So in this case, the national insurance they had paid in the first 2 months, which was calculated using the monthly thresholds, is all being refunded. So that's why they're getting that £472.32 refund. So hopefully that gives some insight into how the calculations are being done. Most important thing for you to keep in mind is that you've selected a director status, and if they've been appointed a director recently, you've made sure that the date directorship began has been entered correctly. So we're just going to finish up this session by taking a quick look at some of the changes I alluded to earlier. So what's new for 2025 to 26? Now, this is really just legislation change. It doesn't change the way a director's national insurance is calculated. The methods remain the same. But from the 6th of April, the secondary threshold has reduced from £9,100 per year to £5,000 per year. And the employer NI rate has increased from 13.8% to 15% on earnings above that secondary threshold. So you can check legislation settings in your software by simply changing your process date into the new tax year and then go to company and legislation. We'll have a quick look at them now. And we'll also look at the national insurance in the first period of the new tax year. So for this one, I'm going to set my process date forward now to my first pay date of the new tax year. It's going to be the 30th of April. To find any legislation settings, you can go to company, legislation, and then in this case, we're going to look at the NI tab. Now, we have got separate sections for employees and directors, but the legislation is exactly the same for this year. There was a year where there was some mid-year national insurance changes, which is why directors had to have their own set of legislation. But you can see secondary threshold gone down. It's below the lower earnings limit. That's the first time that's ever happened. So employer starts to pay national insurance on earnings above £5,000 yearly. And you can see the employer rates on earnings above that secondary threshold is 15% for category A. So looking at a couple of my employees, let's just take the first two. Remember, one is on annual basis, the other is on pro rata. If I go into the enter payment screen, and they're earning exactly £5,000. So there is no employee national insurance on the annual basis because earnings to date are clearly below the primary threshold. And actually at this level, there's no employer national insurance because we're paying them bang on the secondary threshold. But let's say they got £5,500. There's still no employee national insurance, but that is when the employer NI is going to start to kick in. And £75 there, that's your 15% of £500, which was above the secondary threshold. So employers will start to pay national insurance on their directors earlier than they had done in previous years. From the employee's point of view, they're not really going to see much of a change. For the second employee, because they're on the pro rata basis, national insurance is being calculated using the monthly thresholds. So that's what the employee would owe, and that is what the employer would owe. And obviously that would be recalculated in the last period of the year. But if they're getting paid the same, exactly the same each period, that recalculation shouldn't throw up any kind of big differences. But one thing just to perhaps expect at the start of the year is annual basis directors are likely not to pay national insurance unless their earnings are exceeding 12,570. But all taken care of for you in your legislation settings. And as I say, you can check those if you wish to from company and legislation. So with that, it's brought us to the end of the webinar on Directors National Insurance. We are going to stick around just to give you the opportunity to look through any questions or ask any further questions that you may have. And I want to quickly go through some of the further support that's available to you guys. So from a webinar point of view, we are running our payroll year-end webinar series, part 1 and part 2. So I've still got a couple of dates left for part 1, and part 2 will be running through to the 15th of April. So if you haven't already been to those sessions, we take you through preparing for year-end and then processing a year-end and getting ready for the new tax year. Additional topics that we're running this year at year-end include corrections at year-end. Next session for that is on Thursday. We've got starters and leavers and online payslips and P60s. And for those of you that also deal with HR, our next HR advice webinar will be on the 29th of April, and that is themed around redundancy, TUPE and restructure, navigating business cost challenges. So all of these are completely free to attend. You can find all the details and our webinar recordings from the hub at sage.co.uk/webinars. Other support available to you includes our online help centre at sage.co.uk/help, which you can also find by clicking any help icon in Sage 50 Payroll. So use that to search for any support articles that you might need, and also to find contact details for our support team. And we have Sage University, which is an online learning resource. You can create a completely free profile on that one, and you can find your way to the Sage 50 Payroll Learning, which includes e-learning courses, certification, and bite-sized learning. So about 5 minutes left of the webinar. I'm going to have a quick check on the questions. I think most of them have been answered, but we'll leave that open for a few more minutes, give you the chance to read through them. Remember to copy and paste any questions and answers you might want to keep with you. And you can grab a copy of the handouts if you want them from that piece of paper icon. We will send you a recording of the webinar later on this afternoon, so look out for that dropping into your inbox. And if you are leaving us now, please, if you can, just take a moment to complete the webinar survey that should appear when you exit us, as we do value your feedback. We use this to try and improve our offerings moving forward. So I am going to go on to mute for a few minutes, and I will come back to you when we're ready to wrap things up. Hello again, everyone, and thank you so much for sending the questions through. It looks like the team behind the scenes have done a great job answering those. I haven't seen any new questions drop in the last couple of minutes, so we will wrap things up at that point. Just like to take this opportunity to thank you for joining us at the webinar today. I hope you found the topic useful and you've learned something today, and do get yourself signed up to any of our other webinars that you might like to attend. All the details are at sage.co.uk/webinars. So on behalf of myself and the team behind the scenes, thanks once again for joining us. Enjoy the rest of your day, and we look forward to seeing you on another webinar in the future. It's goodbye for now.